You built something most people only dream about. 10 years, 50 employees, and a business now worth $15 million on paper. But look at your actual bank account, and you'll find less than $200,000 in cash. Your CPA tells you if you take a dividend, you lose nearly 40% to taxes. Your banker tells you a loan against your home is the safest option you have. Neither of them is telling you what the wealthiest families in America actually do. They don't sell their assets, and they don't get paid in a way the IRS can easily tax. Instead, they use a mechanism so simple it fits in 3 words: buy, borrow, die. It is not a loophole hidden in an offshore account or a shell company in the Caymans. It is written directly into the tax code, and it is available to you right now if you understand how it works. Tonight, we go past the headlines about billionaires paying almost no tax. We go into the actual mechanics, the actual court filings, the actual IRS rules that make this possible, and we look at what happens when this strategy goes wrong, because it has, publicly and violently. If you are 3 to 7 years from selling your company, this video may be the most important one you watch this year. This is the Business Architect. Welcome back to the channel that studies how money and power actually move in America. If this is your first time here, hit subscribe, because we go where financial media won't. Before we start, understand this is education, not personal financial or legal advice, and every strategy discussed requires a licensed advisor. Now let's open the file on Buy, Borrow, Die. Here's the trap almost every successful business owner falls into. Your entire net worth is trapped inside one illiquid asset, the company you built. On paper, you are a multimillionaire. In your checking account, you are one bad quarter away from stress. You want to buy a second home, you want to fund a foundation, or help your kids start a business. Your CPA says the same thing every time. Sell shares and lose close to 40%. Take a dividend and lose even more once you count state taxes. So you do nothing, and the business keeps eating your cash flow instead of funding your life. Meanwhile, you're carrying a quieter second fear. If you take your foot off the gas to generate more salary, you shrink the earnings multiple that determines your exit price. Every dollar you pull out as W-2 income can lower what a buyer will pay for your company later. It feels like a locked room with no door, but the wealthiest families in the country solved this exact problem decades ago. They just never explained it on the evening news. In the 1990s, a University of Southern California tax law professor named Edward McCaffrey was trying to explain something to his students. He wanted them to understand why the ultra-wealthy paid so little in tax despite obvious, visible fortunes. He distilled it into 3 words that stuck: buy, borrow, die. Buy assets that appreciate, borrow against them instead of selling them. Die and let your heirs inherit everything with the embedded tax bill erased. McCaffrey wasn't leaking a secret. He was describing how the tax code already worked in plain language. Decades later, his phrase became one of the most searched terms in wealth planning circles, because it explains something the average taxpayer never learns. America does not tax 2 specific things. It does not tax unsold assets, and it does not tax debt. Your paycheck is taxed the moment it lands, but an asset that doubles in value while sitting in your name is taxed only if and when you sell it. And a loan, no matter how large, has never once been classified as taxable income under the Internal Revenue Code. This isn't a theory. This is written into Title 26 of the United States Code, sitting in plain sight. Once you see it, you cannot unsee it. It explains why business owners with modest salaries can still be worth tens of millions. And it explains the uncomfortable headlines you've seen about billionaires paying almost nothing. So let's take the 3 steps one at a time, starting with the one you've probably already done: buy. If you own a business, you already completed step 1. Your company stock, your real estate, your investment portfolio. These are all appreciating assets in the eyes of the tax code. The mistake most owners make is assuming the only way to unlock that value is to sell it. Selling triggers capital gains tax immediately, often approaching 40% once federal and state taxes combine. But there is a second door, one most CPAs mention only in passing. That door is borrowing, and it works completely differently than a sale. When you borrow against an asset, you are not disposing of it under the tax code. You still own it. it can keep growing, and the cash in your hand is not treated as income. That single distinction is the entire strategy. Here's how the borrowing step actually functions in the real world. Wealthy individuals use what's called a securities-based line of credit, or an SBLOC, when the asset is publicly traded stock. Banks assess the value of the pledged shares and offer a loan, typically well under full value, to protect themselves. For privately held business stock, the mechanics are similar but far more selective. Specialist lenders will extend credit against private company shares, but usually loan out only 15 to 45% of assessed value. Some private share lenders push loan-to-value ratios higher toward 60% when a near-term sale or IPO is already in motion. These loans are often structured to run 1 to 10 years, aligned with your expected exit timeline. Interest rates on private share loans commonly start around 6 to 9% annually, depending on your risk profile and collateral quality. Many are structured on a non-recourse basis, meaning the lender's claim is limited to the pledged shares, not your entire estate. Here is the part that stuns most business owners the first time they hear it. Loan proceeds have never, under any interpretation of the Internal Revenue Code, been classified as taxable income. You can receive millions of dollars in cash and owe the IRS nothing on it, because legally, a loan is not a gain. This is why a person can be worth a fortune on paper and simultaneously report a tax return that looks almost middle class. It's not fraud. It's not hiding money offshore. It's simply using debt instead of a sale to access value. And once the cash is in hand, it can fund almost anything: a second home, a child's new company, a foundation, or reinvestment into the business. Now, the obvious question follows: what happens when it's time to pay the loan back? For the ultra-wealthy, the answer is often unsettling in its simplicity. They frequently don't pay it back during their lifetime at all. Which brings us to the final step, the one that gives the strategy its name. To understand how far this can scale, look at two of the most aggressive stock pledgers in corporate America. According to Forbes reporting on SEC filings, one major tech founder pledged roughly $62.5 billion in company stock as collateral for a $12.5 billion loan back in 2022. That loan financed one of the largest corporate acquisitions in social media history, and it was never classified as personal income. Corporate governance experts note that banks typically extend loans worth 50 to 70% of pledged stock value, revalued daily. A Fordham University economics lecturer has explained publicly that even a 20% stock decline on a 60% loan-to-value position can trigger an immediate margin call. Regulatory filings reviewed by Financial Press in 2025 showed that roughly a third of that founder's total company stake remained tied up in margin loans years after the original loan. It's a strategy so central to modern billionaire finance that even company board members participate in it. One company's own proxy filing showed a board director had pledged effectively all of his personal shares as loan collateral. This is not a fringe tactic used by reckless outliers. It is a mainstream tool sitting inside routine SEC proxy statements filed in public view every single year, and it isn't limited to one industry or one founder. In 2026, a Wall Street Journal investigation, cited widely across financial media, revealed something remarkable about a software billionaire worth over $200 billion. Roughly 24% of his entire net worth was already pledged as loan collateral to banks. He had also personally guaranteed more than $40 billion to help finance his son's acquisition of a major Hollywood studio. Then his company's stock price was cut roughly in half. Suddenly, analysts were openly discussing the risk of forced liquidation, the exact mechanism that turns a paper fortune into a real-world forced sale overnight. This is the same mechanism your CPA warned you about, just at a scale of hundreds of billions instead of millions. The tool that builds fortunes without triggering tax can also become the tool that unravels them without warning. Compare that to another well-known founder who has kept his stock-backed borrowing near zero by public reporting. Same tax code, same opportunity. Two completely different risk appetites. The lesson here isn't don't borrow. The lesson is that how much you borrow and against what determines whether this tool builds your legacy or detonates it. We'll come back to exactly what a safe range looks like later in this video. But first, we need to understand why anyone would want to hold on to debt forever instead of simply paying it off. The answer lies in the third and final word: die. Here is the mechanism that makes the entire strategy permanent, not just a temporary delay. It's called stepped-up basis, and it lives in Section 1014 of the Internal Revenue Code. When you inherit an appreciated asset, its cost basis resets to its fair market value on the date of the original owner's death. Picture a founder who built a company from nothing, now worth $20 million, with almost none of that as original cost basis. If they sold it themselves, the capital gains tax could easily reach $7 or $8 million. But if they hold it until death and their heirs inherit it, the basis resets to $20 million instantly. If the heirs then sell it for $20 million, their taxable gain is functionally zero. Decades of appreciation simply vanish from the tax ledger, legally permanently by design of the current code. And remember the loan from step 2? In most cases, the estate simply repays that loan using proceeds from the eventual sale after the basis has already stepped up. The interest paid along the way was often the only real cost of accessing decades of tax-free liquidity. This is the closing move that makes buy, borrow, die a complete closed loop. Buy an asset. Borrow against it tax-free while you're alive. Let death erase the gain entirely. It's not evasion. It's not a crime. It is 3 separate, well-established provisions of tax law used together in sequence. In June 2021, ProPublica published leaked IRS data covering more than 15 years of America's wealthiest taxpayers. Their analysis found that the 25 richest Americans saw their combined wealth grow by $401 billion between 2014 and 2018. During that same period, they paid a combined true tax rate of just 3.4% by ProPublica's methodology. One legendary investor reported an average annual income of just $11 to $25 million during those years, despite a net worth over $100 billion. His true tax rate, according to ProPublica's calculation, was 0.10%. Another founder paid 0 federal income tax in 2 separate years, according to the same investigation. A world-famous financier went 3 consecutive years without paying any federal income tax at all. None of this was because of an accounting error, a criminal scheme, or an offshore account. It was because their wealth grew in unrealized stock value, which the tax code simply does not touch until it's sold. And they never needed to sell because step 2 of the strategy gave them all the cash they needed. The IRS itself later confirmed it was investigating how that confidential taxpayer data had been leaked in the first place. But the leak, however it happened, revealed a system that had been operating in plain sight for decades. In the years since, dozens of follow-up investigations have expanded on those original findings. This isn't a fringe theory whispered in forums. It's a documented, sourced, and heavily litigated feature of the American tax system. And now you understand exactly why it works. But understanding the mechanism is only half the story. The other half is understanding exactly how it can destroy you if you get greedy. Let's talk about the unspoken fear every business owner has about this strategy. In the summer of 2008, one of America's most aggressive energy executives owned a personal fortune exceeding $3 billion. Nearly all of it was tied to stock in the natural gas company he had co-founded and led as CEO. He had also personally borrowed heavily on margin to buy even more shares of his own company. That July, the stock traded above $70 a share, near an all-time high. By October, as the 2008 financial crisis tore through global markets, the stock had collapsed by more than 80%. On 3 consecutive days, his brokers issued margin calls he could not meet with cash. He was forced to involuntarily liquidate roughly 94% of his entire stock position. Regulatory filings show he sold over 31 million shares, worth over $2 billion at their peak just months earlier, for a fraction of that price. In a single week, he went from one of the wealthiest executives in the oil and gas industry to a cautionary tale taught in finance classes. This is the exact risk your CPA is quietly worried about when they hesitate to recommend this strategy to you. Borrowing against an asset works beautifully when the asset's value is stable or rising. It becomes a countdown timer the moment the asset's value drops sharply, and the lender demands more collateral. Private company stock carries its own version of this risk, even without a public stock price crashing in real time. If your business has a rough year right before your loan comes due, and no buyer is ready, the lender can force a difficult conversation. This is why every credible source on this strategy repeats the same warning over and over. Never ever borrow against the full value of your asset. Financial analysts point out that even conservative loan-to-value ratios of 50 to 70% can trigger forced selling after just a moderate price decline. This is precisely why private share lenders typically cap loans at 15 to 45% of assessed value, far more conservative than public stock margin loans. The goal isn't maximum leverage. The goal is enough liquidity to solve your problem, with a large enough buffer that a bad quarter doesn't become a forced sale. This is the difference between using buy, borrow, die as a wealth tool and using it as a gambling chip. One builds a legacy across generations. The other becomes a headline warning the next generation of business owners. Now that you understand both the power and the danger, let's bring this back to your specific situation. Because a business owner 3 to 7 years from exit faces a very different playbook than a public company billionaire. If your wealth is concentrated in a private company worth $10 to $75 million, you are not walking into a major bank for a public stock-backed loan. Public margin lending requires a publicly traded, liquid stock, and your shares almost certainly aren't that. Instead, this world uses a smaller, more specialized set of lenders who understand a liquid private equity. These lenders evaluate your company's financial performance, its growth trajectory, and how close you are to an actual sale or liquidity event. Facilities in this space commonly range from single-digit millions up to $30 million or more, tailored to the size of the business. Loan-to-value ratios are intentionally conservative here, often in the 15 to 45% range we mentioned earlier. That conservatism exists specifically to protect you if your valuation dips before your eventual sale closes. Some structures use payment-in-kind interest, meaning the interest accrues into the loan balance instead of requiring monthly cash payments. This matters enormously if your business is cash flow healthy but not liquidity rich, which describes almost every founder-led company in this range. There's also a completely different path some owners choose instead of a loan: the Employee Stock Ownership Plan, or ESOP. An ESOP can create liquidity by selling shares to a trust for your own employees, often with significant tax advantages under current law. It doesn't carry margin call risk the way a loan does, because there's no lender who can force a sale if the market dips. But it also permanently transfers ownership, which isn't right for every owner who still wants to run their company for years. The right structure depends entirely on your timeline, your risk tolerance, and whether you want liquidity now or maximum value at a future sale. This is exactly the kind of decision that should never be made from a YouTube video alone. It requires a CPA who understands your specific financials and often an attorney who specializes in pre-transaction planning. But now when you sit down with them, you'll be asking the right questions instead of nodding along blindly. You can ask directly, what loan-to-value ratio protects me if my next 2 years are rough? You can ask, does an ESOP make more sense than a loan for my specific exit timeline? You can ask, how do we structure this so it doesn't damage the earnings multiple a buyer will eventually pay? These are the exact conversations family offices and estate attorneys are already having with clients wealthier than you. The only difference is scale, not access. And right now in 2026, the rules around this entire strategy just shifted in a way that matters for the next several years. On July 4th, 2025, the federal government signed a sweeping new tax law known as the One Big Beautiful Bill Act. Before this law, the federal estate and gift tax exemption was scheduled to be cut roughly in half at the end of 2025. Instead, starting January 1st, 2026, the exemption was permanently raised to $15 million per individual, or $30 million for a married couple. And unlike the previous temporary increase, this one has no scheduled expiration date written into the law. For a business owner in the $10 to $75 million range, this is not an abstract policy detail. It's the difference between your heirs owing federal estate tax on your business and owing nothing at all. The law also expanded something called qualified small business stock treatment under Section 1202 of the tax code. The required holding period to qualify dropped from 5 years to 3 years. The capital gains exclusion increased from $10 million to $15 million, and the gross asset limit to even qualify as a small business for this benefit rose from $50 million to $75 million. If your company falls inside that range and you've held your stock long enough, part of your eventual sale could be entirely tax-free, separate from buy, borrow, die altogether. This is precisely why this strategy stays relevant for years, not months. These aren't temporary provisions set to vanish at the next election cycle. They're structural changes to the tax code that reshape estate and exit planning for business owners in your exact bracket. But permanence in tax law is always relative to which party controls Congress. And that brings us to the one honest warning every viewer of this video deserves. This entire strategy exists because current law does not tax unrealized gains or loan proceeds. Multiple proposals over the last several years have tried to change that. In 2021, one administration proposed treating asset transfers at death as taxable events, effectively ending stepped-up basis for large estates. More than 130 members of Congress signed a public letter opposing that proposal, warning it would devastate family-owned businesses and farms. Even some lawmakers from the party that proposed it publicly broke ranks, warning it would tax unrealized gains for the first time in American history. That specific proposal did not pass, but the underlying debate has never fully disappeared. Policy researchers have also floated a narrower idea, an excise tax specifically targeting securities-backed lines of credit, the exact borrowing mechanism from Step 2. Neither of these ideas is currently law as of this recording, but they represent the two most likely pressure points if Congress ever moves to close this door. This is why any serious plan built around buy, borrow, die should be reviewed regularly, not set up once and forgotten. The version of this strategy that works perfectly in 2026 could require adjustments in 2029 if the political winds shift. That uncertainty isn't a reason to avoid the strategy. It's a reason to build it with professionals who watch these changes for a living, not with a static plan you set once and ignore. Let's bring this all the way back to where we started. You are not looking for a trick, and you were never going to find one in a YouTube video anyway. What you were actually looking for was permission and a clear map of how people at scale already solve your exact problem. Buy the asset you already have, your business. Borrow against it conservatively, using a lender who understands illiquid private equity at a loan-to-value ratio with real breathing room. And structure your eventual exit so that a trust, an ESOP, or a properly timed sale determines the final tax outcome, not panic. The mechanism is not hidden. It is documented in the Internal Revenue Code, in SEC filings, and in a federal law signed in 2025. What's actually hidden is the confidence to walk into your next advisor meeting and ask for it by name. If you want to go deeper on how this applies to your specific business, valuation, and timeline, I don't do that publicly. I discuss strategy and structure privately, one conversation at a time, on Signal. My username there is the Business Architect 123.43, and it's linked in the description below. I read every message myself. If this video gave you language for a conversation you've been avoiding with your CPA, that was the entire point. Subscribe if you want the next file opened. How family offices structure trusts around exactly this strategy. Every claim in this video is sourced from ProPublica, Forbes, Reuters, SEC filings, and law firm analyses of the 2025 Tax Act, all linked below. This channel exists to translate how money and power actually move, not to sell you a fantasy. Stay sharp, stay informed, and I'll see you in the next file. This has been the Business Architect.